This will be about a 30-minute presentation. Capital Group, I'm more on the side of working with investors, fundraising, marketing, and branding. If you're invested with us and you're on our webinar tonight, you'll be getting my monthly updates on investments that we have with our tight-knit group of private investors, about 50 people or so that invest with us and continue to reinvest with People's Capital Group over the last 10 years or so. And our mission is to transform personal finances and quality of life by creating passive income streams through real estate investments. And I actually got into real estate because I read a book called Rich Dad, Poor Dad. If you haven't read that, check it out. It's a great book. It talks about how the tax code really favors people that own real estate or just and refinancing those assets and the tax finance of real estate. So we've developed a business that allows you to pay yourself through refinancing real estate, except there's a lot of moving pieces to that. There's a lot of heavy lifting. There's a lot of things you have to know how to properly buy discounted apartment buildings, reposition them and get them to refinance properly. So that's what we've executed here. People's Capital Group is a nice turnkey system, an in-house management company, and a way that people who are not experienced in real estate can now participate in the purchase of these buildings, ownership of these buildings, and get the benefits like tax depreciation, cash flow, and a large lump sum upon the refinance without having to do all the heavy lifting or know how to do all the ins and outs of repositioning apartment buildings. And that's what we'll talk about tonight. So the book Rich Dad, Poor Dad says the moment you make passive income and portfolio income a part of your life will change. I see more people jumping on as we go along. Always good to see. If you have any questions, please type them in the Q&A as we go along or the chat here. And yep, so I see another question popping here. That's great to see. We'll keep those questions coming in, and I'll answer all those questions at the end of the night there. I know there are proposed changes to self-directing your IRA, so we'll get into that a little bit later on tonight. Be about a half-hour presentation or so. So People's Capital Group, we were established in 2013. Seth Martinez there to the left runs operations. I do fundraising and property and investor communications and marketing and branding. And Seth had actually sold a medical billing company and transitioned into real estate about 11 years ago or so. And I transitioned being a realtor in real estate into being a property owner. And I started by getting good deals and working with those investors and finding good opportunities for those investors and eventually buying lots of those opportunities ourselves. So together, Seth and I have done over 250 real estate transactions. We have about a $17 million portfolio today, about 120 doors. And we work with about 50 investors that continue to reinvest with us over time. We focus on the North Jersey market, and we have an in-house management company in North Jersey out of Berkeley Heights, New Jersey. So here's our agenda for tonight. Number one, why do people invest in apartment buildings? Why do people self-direct their IRA out of the stock market or their solo 401k out of the stock market into real estate? Right? Why do that? Number two, why do people prefer a syndicated investment? That's where you're able to pool capital together and partake in a larger building. Okay, why bigger is better, and why participating in a real estate syndicate to buy a bigger building is generally a smarter investment strategy in real estate than buying smaller buildings and actually taking larger risk with that. So number three, why do people value People's Capital Group service? Okay, we create a nice turnkey experience here where investors that maybe aren't experienced in real estate or do have some real estate investing experience, maybe they own some properties and recognize the challenges of being a landlord, and it's really not passive if you're on call. It's really not passive even if you're dealing with a management company. So a lot of investors that do own real estate already actually end up investing passively with People's Capital Group. And it really, because of the experience investing with us, is very turnkey and very easy. So let's touch base here with the COVID-19 going on. Real estate values have actually done very well since the COVID started here. And I see another question pop up. Keep them coming. So it's important to understand the real estate market has really shown us actually pretty tried and true through this whole COVID experience over the last 18 months. Single family homes have been very hard to fix and flip. So we've actually stopped doing that. Although Seth and I have fixed and flipped over 50 homes successfully with passive investors, we really don't focus on that. We focus on apartment buildings. We like apartment buildings in North Jersey. They're tried and true. People need a roof over their head. They make income through cash flow while you're renovating them. They allow you to refinance for a nice way of harvesting your equity growth over time. So we really focus on buying mismanaged apartment buildings in North Jersey, getting them to perform better, and then allowing that to produce nice returns for our investors that participate in these apartment buildings. We like self-storage, but don't have anything under contract in that space right now. We're not bullish on office and industrial space. We are not bullish on retail, online shopping. The pandemic has come down pretty hard on a lot of those spaces, although warehouse space is actually pretty strong. So that is a space we're exploring. Hospitality and senior housing, we do like short-term rentals. We do like Airbnbs, that end of the business. But that is a whole different beast, and managing that. And senior housing we like as well, but nothing under contract in that space just yet. So with the pandemic, here's our strategic way forward. And here's what we suggest when also searching for a good syndicate. A real estate syndicate is what we are. It allows investors to pool capital together, and people can get invested into a $3 or $5 million building with as little as $30,000. And owning larger buildings tend to be more profitable and safer investments as well. And also, since they're professionally managed also. So when you're looking for a good real estate syndicate, good operators, you want to plan strategically. First of all, educate yourself, right? What's a good investment strategy? Are you looking for, retail space? Are you going to invest in that? Or do you understand the value of an apartment building and having a roof over their head, and understanding that tends to be a very tried and true asset class? But of course, every asset class is different in real estate. There's benefits to all of them. And also working with experienced professionals. So there's a lot of real estate syndicates out there. Some are huge and work with hundreds of investors and hundreds of millions of dollars and buying $80 million buildings. Others are smaller than ours, and some are mid-sized. I'd say we're small to mid-sized syndicate. And the bottom line is you want to focus on what's their strategy, right? Are they raising capital in New York and New Jersey and then buying many states away and hiring third-party management companies and hoping they do their job right? Which we found a lot of challenges with that. In fact, we hired third-party management companies in the past, and they really dropped the ball. And because of that, we developed our own management company. So we manage all of our assets in-house. And I think that really separates us from a lot of other real estate syndicates out there. And it forces us to also buy in a tight-knit area here in the North Jersey market that we know very well. We've been investing in these markets for years. So I've seen a lot of those syndicates not invest in New Jersey because of all the red tape and the high taxes and rent control. And you just have to know what you're doing and have some experience in this market. And some resources as we do, good boots on the ground to find the deals and navigate on a good high demand market here in North Jersey, and getting good opportunities in this market that most investor groups really can't find. We're able to source them through our experience. So of course, you want to look at the history of the market, your degree of risk, right? Ground up construction tends to have more risk than existing real estate, and location as well. Right now, we're buying a 27 unit, 2 blocks to the train station in Rahway, New Jersey. Allows you to commute into Manhattan in 45 minutes. We're buying it for much less than it appraised for, about $109,000 a unit, which is a very good price for Rahway, New Jersey, downtown area there. So that's the type of deals we look for. That's what we focus on. Mismanaged buildings. Rents are about 30% below market value on that building there. So it's a perfect opportunity for us to come in with our in-house management and turn the building around and make it a more profitable building for our investor group. And that is what repositioning apartment buildings is. And that's what we focus on doing, taking mismanaged buildings, making them perform better through renovation and renegotiating leases, and working with our in-house management company to make the building perform. So why do our investors like New Jersey? Well, we've seen a lot of wage growth here. We've seen a lot of rent growth. Demand continues to grow as well. As I was saying before, if you know how to navigate this market with all the red tape, then it can be a very good market. A couple of years have done phenomenally well on top of that. So it's really a nice, perfect storm of a market growth and forced equity by finding a discounted building and using our in-house management to make the building perform as best as possible. So we have a highly skilled workforce here, number 1 in education, number 3 in household medium income, 20 Fortune 500 companies, number 1 in drugs and pharmaceuticals, number 2 in direct foreign investment. So New Jersey is really a hub of activity and demands, and we see that continue to force values up and hold rent, increase rent values as well. And the hardest part of our job is finding a good deal in North Jersey. Once we find it, the capital is pretty quickly raised, and also the rent is generally higher than what we target. So that's really nice to see. So continued here, why do people invest in New Jersey apartment buildings? Well, of course, they offer legal tax shelters, right? So when you own part of a building with people's capital group, that allows for tax depreciation. Now, when you're self-directing an IRA or a solo 401k, that tax depreciation can be a bit of a wash through, but it does help you avoid things like UBIT, unsecured business interest tax, which that's a whole nother presentation. You can talk to your IRA custodian about what that is, but essentially tax depreciation allows you to avoid a lot of the tax burden of income on real estate, especially if you're not investing through an IRA or a solo 401k. Also, we feel that real estate is a lower risk investment compared to a lot of other options out there, like index funds that just go up and down with the stock market. You really have no control over them. Now, although you're not dealing with the real estate day in and day out and dealing with the shenanigans of being a landlord, that's our job, and repositioning a mismanaged apartment building, there is a lot of moving pieces to that. But the amount of risk at the end of the day, you're really looking at a building that holds demand, a high demand market, a professionally managed time. The risk that are high demand markets tend to hold their value. At least they continue to cash flow, produce income through a recession, and that's really struggled during recession. We've seen real estate do quite well. So also we focus on the New Jersey commute to New York City. So we buy within an hour of Manhattan. We don't buy in the boroughs. We buy outside of the boroughs in North Jersey. We try to buy within cities that allow you to commute into Manhattan within an hour. So our investors like how predictable cash flow as well. And of course, the tax benefits of it just complement the tax benefits of an IRA or solo 401k. So at the end of the day, our investors are able to fund important occasions in life by investing in real estate with us. That might include putting their kids through college or paying for weddings or taking their family on vacation, being able to travel, because of course it's a completely passive investment that grows over time, produces cash flow, tax benefits, and a large lump sum upon the refinance. So a nice passive investment allows you to enjoy the returns instead of working for those returns. That's the whole goal of passive investing. So we also try to limit the risk with the debt. Okay, so Seth and I, my business partner, will personally guarantee the debt, or we'll sign for the debt so that our investors don't have to. Now, if you were to take your investment capital, your IRA, your solo 401k, and self-direct it into, say, a duplex that you could buy in Morristown, okay, sounds great. Maybe you get a nice rent amount of $2,500 per unit, Morristown, that sounds pretty reasonable. And but that could be a good investment over time, sure. However, in that case, what you're going to run into is probably personally guaranteeing the debt. So say you put down $200,000, you get a mortgage for $400,000, and allows you to buy a duplex Morristown. Yeah, that's probably about 600 grand at this point. So that's that. In that case, you're taking on that debt of $400,000. You're on the hook for that, whether the building goes in foreclosure or any other scenario. So you want to make sure you understand the risk of personally guaranteeing debt. And Seth and I will take that risk on so our investors don't have to. So that allows our investors to limit the risk to the amount of their investment and not have to sign on the dotted line for the mortgage. And that's a huge amount of risk we put on our shoulders to make sure we get good terms on the loan as well. Okay, so we talked about how we focus on properties with easy commutes to New York City, high millennial demands. We make properties a nicer place to live, a safer place to live, make it smell better, look better. We buy properties in Newark, Passaic, access to New York City there. We really try to make it so you feel a pride of living there, a pride of ownership in the unit, even though you're renting. And that allows the tenants to beat up on the units less and pay their rent on time. And a happy tenant equals a happy investor. Right? We can't just go into these properties and be like, new sheriff in town, and here's the rules. That's not how it works. There's rules we have to follow, and we want to make sure we follow those so we stay on the right side of the law and we don't induce any fines or anything like that. So you really have to work with the tenants in these scenarios. You get more flies with honey, as they say, and that's how we treat these situations. We go in with our best foot forward. We help our tenants find maybe access to new housing if we're working on a cash for keys, or maybe we figure out what their needs are in the unit, fix the unit up, get those needs taken care of, and then they're going to understand for, we're going to ask for a higher rent, which they're usually willing to pay a little bit more rent for a good environment, that their calls are taken care of. When something breaks, the handyman actually comes quickly, professional management with a nice welcome package. So by managing the property from A to Z, that allows the investment passive. We have a nice exit strategy by anywhere upwards of maybe $100,000 asset or so. So people like the idea of tapping into expert real estate knowledge, being lifted up above the pitfalls, and acquiring this has taken years for Seth and me. Develop the relationships with brokers and wholesalers so we can find these opportunities that are off market. And of course, our investors value their free time, not having to secure complex financing, which is a big part of the investment as well. So once we buy the property, we talked about how we force equity into the building by appreciation of infusing capital into the building with renovations and renegotiating leases. This allows for stronger net cash flow, which is going to produce cash flow to the investors. Of course, if you're investing through your IRA or solar 401k, that's tax advantaged cash flow, but you can also accept the tax depreciation to write off that cash flow. And then every 3 to 5 years, we do a refinance every 4 years roughly, and that allows the investors to have an exit option to get back their initial investment. It also allows the investors to get back about half of their investment at the refinance. So that's a big liquidity event for our investors, and they really enjoy the refinance. And that's actually tax-free money as well. We'll break into that a little bit more in this presentation. So together, Seth and I will invest up to $10,000 a month sometimes to find a good opportunity. We'll look at over 400 properties to find that one diamond in the rough, the mismanaged building for a good price in a high-demand market in North Jersey. And we have over 10,000 people in our network, whether that be investors or landlords or wholesalers or realtors and just real estate professionals, people in the industry, people out of the industry. We have almost 4,000 people in our meetup group. We've been doing events and webinars for about 8 years now in the New Jersey market. So many of us have maybe seen me speak at an event, or we've met at other real estate networking events, or met at our own real estate networking event. But we're very active in the local market, and that's important to be out there and be a voice and be a leading voice in the local New Jersey market. So hopefully we're out there and you see us. People's Capital Group has secured funding on over 250 properties, about $40 million. And right now we have about 120 units, about $17 million in assets. We buy and sell real estate over time, but for the most part, we're focusing on buying apartment buildings now and holding on to those long term as we reposition and refinance for our investors. All right, number 3, why do people value PCG's service? Our aggressive calculating business model. So we'll break into this quickly, and then we'll go more to the IRA part of the presentation. Right. I see more questions are popping. Ideal. So we market to out-of-state landlords and worn-out landlords, other wholesalers and brokers. We try to get off-market deals and pocket listings. So if it's something sitting on the MLS, chances are it's not that great an opportunity. So we cherry pick an off-market opportunity. We really look for forced equity, right? So a good deal is not found, it's created, right? You might look at a bunch of deals, but you have to look a little further sometimes, kind of look under the covers, say, wow, okay, so this property in Rahway's 27 units, 109,000 a unit. Well, other units in town are going for like 170, 180. Okay, so that's pretty good right there. We're getting a really good price off the bat. But what's the catch? Okay, well, the units need kitchenettes in the studio apartments. Some of them are smaller, but there's a big parking lot. Okay, there's pros and cons. It's 2 blocks to the train station. Rahway's been an extremely hot market with a lot of growth in that downtown market. They have the Art Center, which has really been booming property values and booming the hype for that downtown area. So we're very bullish on Rahway, and we're bullish on the opportunity there to buy it. And the rents are 30% below market value. So right off the bat, we know we have 30% to grow rents. And then if we put money into the property as well, improvements into the property, well, now the rent can really grow from there. So we see those opportunities with forced equity, forced value add opportunity in those properties, and that's what we focus on buying. Then, of course, we'll go out to our investor group. We'll pool the capital together. Some of our deals will fund in a week. Others take up to 30 days. It depends on the opportunity and how many opportunities we're funding at that time. And then, of course, we close on the property. That produces passive income to our investors through cash flow, which takes a little while to get going. Each product's a little different. And then, of course, the refinance allows for a large lump sum upon the refinance. And the investors have the option to exit each refinance as well if they choose to do that. But a better tax strategy is to stay invested. Most of our investors choose to stay invested over time as well. All right, so as we increase the net cash flow, that increases the property value. When we increase the property value, that'll increase the equity. Okay, your equity is the property value minus your debt. That's what your equity is. And then we increase your equity, that increases the cash from the refinance. And of course, more cash from refinance means more tax-free income to investors. Now, the reason that's tax-free, and I know we're talking about IRAs and solo 401ks tonight, so those are obviously tax-advantaged asset classes. But if you were investing with it, say out of your savings account or just a cash investment, the refinance is great because if you don't exit the investment, of course, you have the option to, but if you choose not to, you stay invested long-term, you keep getting the cash flow quarterly, and the refinance lump sum upon every 4 years or so. So around year 8, you'll make back your entire investment plus some. But it's really a good tax strategy because the cash from the refinance is essentially tax-free capital, right? And we're not selling the building. It's not cash flow. It's debt. Now, it's low interest debt that our tenants will pay down for years. So it's good debt that Seth and I will sign for so our investors don't have to. But debt is not taxable income according to the IRS. So this is a great strategy to harvest your equity growth, take some cash off the table, split it up amongst the investors. And right, this is where Seth and I get paid too. We have to do our job right to get paid, right? We don't have overriding asset management fees or anything like that. So we got to perform to put food on our plate as well. So you better bet we want to hit that mark on the refinance. We want to hit the mark on the cash flow. And historically, we've done about 10% better than targeted. So the bottom line is the less money you're going to pay to the taxman, the better your ROI is. So with our aggressive and successful repositioning track record, we're repositioning the building. That means you're buying a mismanaged building. We're making it perform far better by putting capital into the building, improving it physically, but also renegotiating leases and working with current tenants, working out cash for keys with other tenants. Maybe there's common areas you need to improve as well. So we focus on having low vacancy rates and high collection rates. I think our worst month in the middle of this pandemic was about an 87% collection rate. That was our worst month. Usually we're around 97% collections. So we have exceptional tenant care. We really focus on the tenant first. A happy tenant equals a happy investor, as we say. Calculated construction costs that stay on budget. It's a big part of this job, is making sure your construction stays on budget. Your contractors don't mess around, right? That's a notorious part of this business for having overages and being a difficult end of the business is construction and renovation. So we have very good contractors and we only manage our own properties. So we're laser focused on our own properties and our own contractors that we work with. And that creates consistent cash flow and a real passive income stream with that exit strategy every 4 years for our investors. All right, so an easy exit strategy here after 3 to 5 years of repositioning the property, we're going to refinance. We're going to harvest some of that equity growth. It's going to allow the investors to make about a 50% return on their investment, get about half of their investment back. That's always our target at the refinance. So at this point, the investor will have 2 options: to stay invested in the LLC, continue to get the quarterly cash flow check, get another lump sum upon the refinance around year 8, probably another lump sum upon year 12. Eventually, we'll trade into a bigger building with a 1031 tax deference, and then the returns can be the gift that just keeps on giving. So we have a very long-term view of real estate, why about a third of our investors self-direct their IRA or solo 401k into real estate, is because we have such a long-term view of it. And my attitude is also I'm very heavily invested in real estate, and it's done very well for me. Where am I going to really exit and put my money into, right? The stock market, okay, that goes up, that goes down. I don't really like the stock market because I can't control it. I like assets that I understand. I understand housing more. People need a roof over their head. It makes sense to me. It's a necessary commodity. So our attitude on real estate is really long-term. We like investing in real estate. We're going to continue to use the tax tools like the 1031 tax deference to trade into bigger buildings, beat the tax man. The refinance is a tax tool to beat the tax man. So we're going to continue to offer that option to our investors. And some investors need to exit just to get back their initial investment for personal reasons. And that option is there at each refinance. You can sell your share in the LLC, get back your initial investment, keep the funds from the refinance, keep the funds from the cash flow. But of course, there will be capital gains tax. Now with an IRA or solo 401k, you would defer those taxes. So the whole idea is to invest with a self-directed IRA is to defer capital gains tax. Okay, so syndicated investment enables a group of people to pool their capital together, as we were talking about. We've pulled about a little over $7 million to date, and our minimum investment is $30,000. And we really pride ourselves on working with investors that sometimes invest the maximum investment, which is $500,000, and have over $1 million with us. And those are accredited investors. And we also work with smaller, sophisticated investors. These are people with maybe $30,000 to invest from their IRA or solo 401k, or just want to diversify some of that into the stock, out of the stock market into real estate. And that allows them to get started with real estate investing. They learn a lot from our monthly updates. You know, we really pride ourselves on giving in-depth monthly updates, quarterly financials. So our investors are educated along the way, a ton of transparency. A lot of the feedback we'll get is that we're very transparent, which is quite a compliment. And so we really pride ourselves on working with small investors getting started with just the minimum investment of $30,000, maybe $50,000, you know, getting started with investing in real estate. And we have to make sure you're qualified to do that. Not everyone qualifies. And the qualification process starts at peoplescapitalgroup.com. You can fill out a qualification form there. But essentially, we want to make sure you're good fit for us, that you have a minimum investment amount plus some capital, understand the investment opportunity, and don't need to live off the returns of the investment. But as long as you qualify as that, then you should qualify to invest with People's Capital Group. And we really pride ourselves on working with all different levels of investors. So if you're not sure, you go to our website and fill out the application form, and you can learn more about it if you qualify there. We'll set up an introductory call. Okay, let's go over a couple case studies, and then we're going to talk more about the IRA into the session here, and then we'll focus on the questions I see are coming up. More and more are coming up. It's good to see. So here's an example of a 5-unit. Now, this is a smaller property, but it just goes to show when you buy and renovate and refinance and kind of wait over time, as Warren Buffett says, don't wait to buy real estate and wait. It's really true. Real estate over time in the right markets, well managed, really just is such a exponential growth. It's just so exponential over time. We'll see here is we bought this property for $110,000. They were asking $130,000. It's a 5-unit near Rutgers University in Newark, New Jersey. So if you know anything about the property values in near Rutgers University in Newark, New Jersey, you'll say, holy mackerel, I wish I could get a 5-unit for 110. And I agree. If I knew then what I knew now, boy, I'd buy more of them. This is 2013. So we bought it for $110,000. We captured $20,000 in equity off the bat, although really more than that, because we got it for such a great price. Needed a small amount of renovation. That's what we focus on. You know, lipstick on a pig. Less is more when it comes to renovation. So we really put about $30,000 into the property here. And 1 year later, it appraised for $310,000. So we bought it for $110,000. We put $30,000 into it, and then 1 year later, it appraised for $310,000. Grown value. We're not about 70 value, maybe 70% property value. We're never owning even a property value. All right, I'm sorry about that. Unfortunately, my internet cut out for a second there, but I'm back in action here. Hopefully everyone can hear me. All right, let's focus on the next case study here. It looks like everyone still is on, and it looks like my microphone's working. So if you can't hear me, just write in the Q&A or the chat. But it looks like we're back in action here. So here's our second case study. This was a 25 unit we bought in 2014. We sold in 2017. We owned this for about 18 months and sold it for a nice profit. The reason we sold the property is because it was about 90 minutes away and was hard to manage. So we learned from this to buy properties closer to us because it's much easier to manage if you're within about 45 minutes to an hour from the property at most. So they were asking 1.2 million. We paid $1,075,000. So that's our job, get a good price right off the bat. So we captured $125,000 upon purchase. We secured a bank loan for 75% of the purchase price at 4.5% interest. Back then, I remember people saying, man, interest rates are super low. You better buy real estate now. Now we're getting interest rates for like 3.25. It's incredible. So really incredible where interest rates are right now. That's why it's another good reason to buy and own real estate long term, because interest rates are so low. The cost of money is very affordable. So why not lock that in at this time? So we had 4 investors come in with $100,000 each. It's not always that clean. Often we have an investor at $500,000, another investor at $30,000. So it's generally split up in different pieces like that. And in this case, People's Capital Group owned 40%, the investors owned 60%. And we sold the property for $1.35 million. We were able to make about a 26% profit for our investors. So we hit about a 11% cash on cash return for them annualized. We targeted about a 9.5% cash on cash return for them annualized. So we did about 10 to 15% better than target. And that's usually what we're hitting. And that's usually our goal, is to hit about a 10 to 20% over target is our goal. And historically, we've been able to accomplish that. All right, so let's dig into the IRA portion here of how to self-direct your IRA into real estate. We spent the last half an hour talking about the real estate end of it and how People's Capital Group buys mismanaged apartment buildings and pools together capital to buy them, and the advantages of that for our investors and having passive investments in real estate altogether. So if you're looking to do something with your IRA or your solar 401k, the first step is selecting an IRA custodian. There's plenty of them out there. There's about 50 different IRA custodians that I'm aware of, and more are popping up every day, I'm sure. They all have different fees and different structures, but they're all kind of the same, but very different, if that makes sense. And depending on what you're trying to do with your IRA, you want to select the right IRA custodian for you. Some allow you to start an LLC that's going to be owned by your IRA and managed by you. That's called a checkbook IRA LLC account. You don't necessarily need to take that step. It's simple, and self-direct your IRA or solar 401k into an IRA custodian, and then from that custodian into an investment opportunity, say with People's Capital Group. So here's the process. So if you decide to self-direct your IRA, the first thing you want to do is select shop around yourself, find the right IRA custodian for your goals, and then fill out their paperwork to start an account with them. It's generally no more than like $200 to $300 to start an IRA account with a custodian. So pretty affordable process. The next step is then to go ahead and self-direct your IRA from where it's at. So say you're with Fidelity, you want to take 30% of your IRA. So you tell your IRA custodian you want to do that. They'll contact Fidelity, and Fidelity will send over 30% of your IRA to custodian there. At that point, your custodian is holding the funds, and then you can decide what you want to invest in. Now, there's rules and regulations what you can and cannot invest in. Okay, you can't put your kid through college. You can't buy a vacation property and take your family there for free. Okay, you have to make sure you're following the rules, and your IRA custodian will make sure of that. So your IRA custodian is going to look over whatever investment opportunity you bring to them, and they're going to guide you on if you can or cannot self-direct your IRA or solar 401k into that opportunity. Now, they're not going to tell you if it's a good investment opportunity or that's not a good market or don't trust this guy. That's not their job. that's your job, is to do your due diligence on the operator, the investment opportunity, figure out if the investors have, the operators have a good track record. Does the investment make sense? Does the strategy make sense to you overall? And if so, then, pull the trigger on the investment. And at that point, the IRA custodian review the operating agreement and review that information. Now, we've developed our operating agreement and our funds just so they are acceptable of IRAs and solo 401ks, so they're IRA friendly. And that means that your IRA custodian should approve our operating agreement pretty quickly and easily and be able to sign off on it. And that would allow you to then self-direct your IRA into the operating agreement there, into the LLC created to purchase the real estate. Now, with our acquisitions, the funds are held by the title company prior to closing. So that's just how the process works on our end. But of course, your IRA custodian will review the process and review the wire instructions and wire the funds to the right place. With our closings, the funds are then held by the title company until we go to closing. If we don't own the real estate, the positive cash flow checks are then sent back to your IRA custodian. The lump sum upon the refinance is sent back to your IRA custodian, and that allows you to then build your IRA with that IRA custodian. And then over time, a lot of investors tend to reinvest in opportunities with People's Capital Group. As we perform more and more with more investors, about 90% of them reinvest over time, and that allows them to get participating in different opportunities, different properties, maybe some that cash flow more quickly, or others that are bigger projects and take time but could be very valuable down the road. So a lot of our investors enjoy that every 4 to 6 months, we tend to have a new opportunity in their inbox, and that allows them to participate in a bunch of different types of opportunities in North Jersey. So that's the process, self-directing your IRA into real estate. It's a way to build your nest egg faster. It's not a way to take the money out and pay yourself sooner. It's not a way to, take the money from your IRA and use it for things that are not allowed, but it is a way to take control of your retirement account, and actually put it into an asset that you understand, that you get really in-depth updates on, and actually improve inner city communities as well. Especially if you lived around a lot of these cities, Rahway, New Jersey, it's kind of nice owning a building in Rahway, New Jersey, a mismanaged building, and making it perform better. So that's what we focus on with People's Capital Group. Hopefully everyone can hear me here. If you have any questions as we go along, I know I lost the internet for a second there. Hopefully you can still hear me fine. I'm going to answer all the questions at the end here. So we're going to go over 3 types of investors that tend to invest with People's Capital Group, and then I'll wrap up for the evening and answer all the questions we have. So we have 3 types of investors. We have a high income investor. This is someone that's probably an accredited investor with a large stock portfolio, enjoying stock dividends. Our investments offer cash flow, which is comparable to dividends. Dividends are taxed, and however, with real estate, tax depreciation is offered to allow you to write off that cash flow. Of course, with a tax advantage account like an IRA, you can have a tax advantage income either way. We do feel, though, the real estate's more predictable than the stock market. We do feel it's more recession resilient. So a lot of accredited investors, large net worth individuals like us to have a more predictable income and a more predictable asset class with real estate that, of course, they don't have to manage day in and day out. Second type of investor that really enjoys working with us is an active real estate investor. This is someone that's probably managing properties or owns real estate already. Maybe they're managing a management company and realizing that's not passive either. They're used to guaranteeing a mortgage, being on call with their real estate, being limited to buying smaller properties because they're not pooling capital with a bunch of investors. And of course, pounding their head against a wall come tax time with filing taxes and all the fun parts of that. So with People's Capital Group, of course, there's no management. There's a quarterly passive income check once the building's producing cash flow. With a syndication model, it limits the risk, so they don't have to sign for the mortgage. They're not on call anymore, and they can buy a bigger property by pooling capital together. Now they can get in on a 30 unit or 40 or 50 unit property, which produces better cash flow and better refinance capital. And of course, our CPA coordinates tax time, and the K1 is sent out at tax time in a nice, easy way so that it's enjoyable for the investor at tax time as well, if things make sense. So here's the third type of investor we have, the IRA investor. Generally, IRA brokers tend to have fees. People's Capital Group does not have an overriding asset management fee. We make our returns through ownership of the real estate, just as our investors do. So that's an incentive for us to perform. We do feel the stock market is more volatile than the real estate market. And of course, real estate offers tax appreciation. And also, we feel real estate's a little more predictable, especially as we own the properties and manage them in-house. We know these markets we're investing in. We do feel the values of them are a little more easy to predict down the road than the stock market. And of course, seeing a difference in the inner city community. So Newark, Patterson, Passaic, Rahway, Plainfield, Jersey City, all these markets we've owned and operated in. We've put people's IRAs to work in these cities and improve the cities so that they can see a tangible effect. You know, it might be building by building, but it's nice to see your IRA or your solar 401k actually make a difference in an inner city community. Maybe you grew up around that area. Maybe you know that area. You know how many challenges they've faced. And it's nice to see your money actually making a difference, improving a property, making a nice family-friendly property there, a nice safe place to move in and raise your family. And your money is making a difference in doing that. So that's a nice tangible effect of this investment that you really don't get with the stock market. Okay, so here's some client feedback from some of our 3 of our 50 investors here. Tim Carey, 5-time investor. I continue to grow my investing relationship with People's Capital Group. They have a great history of buying properties at a good price and offering value. Here's Frank Bacuzzi, 4-time investor. My investments have been on point. I like not having to manage the properties. Here's Chris Salerno, 6-time investor. I've been investing with People's Capital Group for nearly 5 years now and cannot be happier with the process and the return on my investment. Aaron, Seth, and the rest of the crew are fantastic to work with. They're like clockwork and they're up. So that's it for tonight. I'm going to answer the questions in 1 second here, but if you do feel like this is a fit for your investment goals, if you want to learn more about self-directing your IRA or just connect with Alan Johnson, who can help you select the right IRA custodian for your goals, go to peoplescapitalgroup.com and click the button that says click here to invest. In fact, I'll go to our website here. We have a ton of stuff on our website. You can check out our podcast, the Passive Cash Flow Podcast. You can check out other information, frequently asked questions, past webinars, tons of information about our company here. And then, of course, you can click here, qualify to invest, and you can either fill out the qualification form to get qualified and get on our investors list. Or if you're not ready to quite do that, you still have some questions you need answered, clear to schedule a discovery call with me, and that'll bring you to a calendar here. You can actually schedule a call with me, Aaron Fragnito, and that'll allow you to have your questions answered and to see if this is a fit for your goals and just talk about what we have coming down the pipeline here on our end and your real estate investment goals for your capital as well. Sorry, the sound was breaking up. If there are changes to self-directing your IRA, we'll have to cross that bridge when we get to it. I haven't reviewed the new rules on that or the proposal, but I'm hoping that it's not going to be passed. In my opinion, I don't think the current administration would do anything to piss off voters even more. The last month and a half has not been a ton of good headlines for Mr. Biden. I think right now he could probably go for a few good headlines, a few wins. Limiting what the middle class can do with their IRA and their hard-earned retirement cash is probably not a good way to win voters. So my opinion is they're not going to stop people from self-directing their IRA. Although, of course, nothing would surprise me with our government these days. Okay, second question. Eric. What is the EQRP offered by Damian Lupo and what those letters stand for? Again, if you have any questions as we go along, you can always email us at info@peoplescapitalgroup.com. All right, here's another question. What are the exit strategies for investors? So we talked about that. The exit strategy is the refinance. Every 4 years or so, the investor has the option to get back their initial investment, keep the funds earned from the refinance, keep the funds earned from the cash flow. And of course, with an IRA or solar 401k, that's going to be a tax advantaged income. However, if you are not investing through an IRA or solar 401k, you will have to pay income tax at that point, which is not, of course, good for your situation. So the average holding time frame there would be a 4-year period. That's what we're looking at. And how long to, the next question, how long to liquidate the investment cash in case of an emergency? Well, again, our job is to qualify you so that you don't call us up in 6 months and then say, oh, shoot, I need that $30,000 back. Part of our qualification process is, do you need these funds in the case of emergency? Do you have excess savings? Do you need to live on the returns? So if you said, I do need the funds in case of an emergency, you would not qualify to invest with People's Capital Group. If that's the case, keep saving up money, keep putting money into your IRA, keep putting money away for those emergencies. And then when you do have $30,000 to invest in real estate, you don't need to live on returns. You don't need to, in case of emergencies, you have excess savings and excess income, then you would qualify to invest with People's Capital Group. If you're not really sure, you're on the fence, well, fill out a qualification form, schedule a call with me, and we'll talk more about it, and we'll figure out if you're qualified to invest with us. Okay, that looks like all the questions for tonight. I'm sorry about the internet connection here. I don't know what the heck is wrong with my internet. It was great all day, and now I do the presentation and it stops working. That's technology for you. But hopefully everyone was able to get the gist of the presentation tonight. If you have more questions, just email us, info@People's Capital Group, or go to our website, fill out the qualification form, schedule a call with me. Let's connect. Let's get your questions answered and see if People's Capital Group is a fit for your investment goals. That's it for tonight. Enjoy your evening.